Good morning. Today we're taking a second look at Zip, the buy now, pay later company, which I covered on the 20th of January. It's now the 31st, and for those who are paying attention, you will know that Zip plunged dramatically, more than 20% yesterday. So this is the perfect opportunity for me to explore what is going to become a theme in this channel: the opportunities that are presented by the drastic overreaction of the market to what is interpreted as bad news. It's pertinent for anyone who was watching my video on Zip 11 days ago, and especially pertinent to those who took the recommendation. So today I'm renewing that recommendation that it's a good time to buy Zip, and I just wanted to step through the reasoning behind the initial recommendation and the reasoning behind the new recommendation, that this is a perfect opportunity to buy into a very well-performing stock. So what we have here is the lifetime chart for Zip starting in 2010. What we see here is that prior to COVID in 2019, Zip was making exceptional progress. COVID had a similar short-term effect on this stock as on every other stock, but what you all know about COVID was that the lifestyle that was inflicted on us for the following years was obviously going to play into the hands of companies that had an interest in online purchases. So Zip was perfectly positioned to take advantage of that, which it of course did. With the end of COVID, with supply chain issues arising from COVID affecting the capacity of online retailers to actually deliver their stock, and for a number of other reasons, Zip came back down to earth in 2022. And what we see thereafter, having demonstrated a sort of classic volcano profile, where the stock frantically overvalues, where the market frantically overvalues a stock, we now see the more considered valuation of the stock by the market. With this growth from the beginning of 2024, largely due to expectations about what is going to happen as Zip penetrates the American market. So these are the financials, and you can see that Zip has been losing money essentially for most of its operating life, but that its losses are fading, and there's a reasonable expectation that the company is about to move into profit. What is significant is that following its entry into the United States market in 2021, and the efforts to take advantage of the situation with COVID, the stock's performance financially has improved as far as revenues are concerned over the next 3 years. So here was one of the factors in my recommendation, and again, this is an opportunity to explore the way both the stock market itself and the investing advice industry operate. Let's keep it neutral. This is Livewire's presentation on, or part of the series on the outlook for 2025. And what we see here is Pendle's Rachel Folder recommending Zip as her growth stock of 2025. The rationale was that Zip had the capacity to significantly increase its revenues by expanding its market share in the United States market, one which is some 13 times larger than the Australian market, where the company was initially founded. What happened next was what happened yesterday, and this is the coverage that you can get from a Google search, with the stock dropping more than 20% on the back of what was perceived, and perceived is the operative word, what was perceived as being a negative quarterly report. So here is the report in question. You can pause the video and take a close look at it if you'd like. But what caused all the concern was this operational performance down here, with the performance in the Australian market going backward in relative terms to past performance. What I think was vastly underrated in the market's assessment of the significance of this report is the very significant improvement in performance in the much, much, much larger North American market. And the reaction we got from the investing advice industry was pretty simple. This is AusBiz's stock of the day coverage from yesterday, where the consensus was that having lost more than 20% of the value of your Zip holding, the thing to do was to sell it and crystallize that loss. This is not the advice that I would be giving. What we see here is the short-term chart, and the MACD, which is, of course, the central thematic of this channel. What we have is, this is the end of 14 months of continual growth, and we have a retracement, and it was at this point on the 20th that I recommended that this was an ideal time to buy Zip. Then we had yesterday. So, as I've said, what is emerging as a dominant theme in the approach taken by this channel is that what we see here is a drastic bot-led overreaction to what was not, in total, a negative report. The bots obviously don't think for themselves, no matter what you're told. The impetus for this kind of drop comes from the human mind. Now, here is this chart with a different set of indicators. Here's the 20-day moving average, the 90-day moving average, and the 200-day moving average. what you see if you do an analysis on this basis is that there will come a time when the stock returns to growth. If you want to wait for an indicator from the MACD, you will be waiting for a while, and that might be a wise and more considered approach. But the other approach to take is that this is an aberration, and that entering or starting a position in Zip at this point is going to see quite quickly a return to growth, and that if you bought into Zip on the 20th, then one of the strategies you might consider is to go again. Drop your average price and look forward to recovering the 20% loss in a much shorter period. Up to you. But as they say, the Chinese word for crisis is the same word as opportunity. Bye for now.